If you work for a high-growth tech company, then equity is likely a very large part of your compensation. And if there's even a whisper of an IPO coming up, then you need to understand how this equity will impact your financial future. Understanding tax ramifications and the decisions that you can make are going to be critical in maximizing this opportunity. As a financial advisor to some of the most successful Silicon Valley tech professionals, I have helped guide people through countless IPOs. And here's exactly what you need to know. Now, equity is extraordinarily valuable, but it's also incredibly confusing. Rules are constantly changing. The different types of equity interact with one another. It's not just about maximizing the amount of money you're going to get back. It's about making sure you don't blow yourself up with taxes in the process. There's primarily three types of equity that you may have: incentive stock options, non-qualified stock options, and restricted stock units. Incentive stock options and non-qualified stock options are usually awarded to employees during early stages of a company's formation. RSUs, on the other hand, are usually awarded at the later stages. And if you're getting awarded RSUs, you can probably get a sense that you're getting pretty darn close to an IPO. Let's start with ISOs. Now, ISOs are going to be the most complicated equity compensation that you can receive, but they also have some of the best tax benefits. When you get ISOs, the initial exercise does not trigger any taxes. And then if you hold the ISOs long enough, or what is called a qualified disposition when you eventually sell, all those gains between the exercise price, the strike price, and the eventual sales price all get taxed as long-term capital gains. So it's very advantageous for individuals to have that. But here's the catch: alternative minimum tax. And what I mean by that specifically, as a difference between the strike price and the exercise price, is counted as a preference item. And this preference item, while not directly taxed to you, if it's large enough, can trigger what we call alternative minimum tax. Now, the formula is very, very complex, and the best way to essentially figure out whether you will trigger AMT is to model some tax returns out. The biggest challenge with AMT is the fact that you could potentially have a tax bill on value that you haven't actually received. And if the IPO is far enough out or never actually materializes, what that means is that you could have potentially paid taxes on your ISOs without actually getting any economic value out of it. So how do you get around that? One of the primary strategies that we always advise clients to consider is what's called an early exercise. An early exercise is done through something called an 83B submission. What it allows you to do is exercise the stock options before they even vested. And if the spread between the exercise and the strike price is small enough, you don't have to worry about AMT. Some of the most popular times to do that is right when you get the award, because the award is going to be awarded at the exact value of your strike price, and therefore there is no spread. Now, here are some considerations around an early exercise. First of all, you're tying up cash, and what that means is that if the company never goes IPO or actually goes bankrupt and ceases to exist, you're going to lose that cash. Furthermore, if you decide to leave the company before those ISOs actually vest, what will happen is that you're going to get back the money you put in, not at the higher value, but whatever you purchased them at or exercised them at originally. ISOs in general are really complicated, and there are some key examples where it has gone exceptionally wrong for people. A good example of this during 2001, when people were exercising ISOs, recognizing AMT, and then we had the 2001 dot-com crash. They had no way to pay back the taxes. Another good example is WeWork, a hotly anticipated IPO that never formalized, and a lot of people essentially paid taxes on AMT and were never able to recover that or realize any economic value. In addition to that, if you decide to continue to hold ISOs once the company becomes public and the value drops, then you run the risk that once again, you're not going to capture that economic value. So even though they have these distinct advantages, if you hold them long enough, there's just a lot of risk involved in it. So careful planning is imperative. And keep this in mind, the difference between ordinary income and long-term capital gains at the highest tax bracket is about 13%. So if your company value drops by 13% or more, you basically lose out on that benefit that you originally were trying to secure. So what are some of the things you should be thinking about when it comes to exercising ISOs before an IPO? The first thing you should be thinking about is exercising before the IPO, but after vesting, it eliminates your risk of forfeiture of owning those shares or those stocks. It still carries AMT risk if you're now exercising when the strike price and the exercise price is large enough. So you have to be careful to make sure you're not incurring AMT or you're ready to pay that tax bill. A very common strategy for exercising ISOs is exercising them about a 6-month period before the IPO. The reason why is that usually if there's a lockup after the IPO of another 6 months, this creates that about year-long window that allows you to participate in the long-term capital gains. And of course, always keep in mind what the liquidity event is structured as. Is it a traditional IPO, which usually has lockup periods? Is it a tender where you can immediately sell the shares and thus maybe it disqualifies you from that qualified holding period? Or is it a direct listing where you can actually sell the shares immediately and you have the full flexibility of choosing when to recognize that tax bill? Now, exercising ISOs after an IPO is usually a lot easier and creates a lot more flexibility. Not only are you going to have certainty that you can actually sell the shares to pay the tax bill, but there's also a market for it, so you get full liquidity. Another thing to consider is when you recognize AMT and you have that AMT tax, you also get what are called AMT credits. And what that means is when you essentially sell those shares at a long-term capital gain, and you recognize that tax for long-term capital gain, if it's higher than AMT, then you can actually use those AMT credits to offset the taxes of those gains. So you can utilize those AMT credits a lot more effectively once the stock is public. A common strategy for exercising ISOs after the company has gone public is exercising early in the year, about January time, seeing where the stock price goes. If it continues to grow, then you continue holding it for the qualified disposition. But if the stock price goes down in value, what you do is you sell to recognize a disqualified disposition and also avoid AMT in the process. You can also exercise ISOs over multiple years in order to make sure you're not approaching the AMT territory, but that requires detailed modeling and it's not guesswork. Now, when you do decide to sell ISOs, and if you decide that you need proceeds in order to exercise the shares, do keep in mind that selling anything before the qualified disposition gets taxed as ordinary income. You may also think about it, if the AMT tax bill is large enough, you may want to sell additional shares and exercise some ISOs in order to actually pay that tax bill. And then finally, if the shares continue to appreciate and you think there's still more upside, you may just decide to continue holding it in order to participate in the capital gains and appreciation. Now let's talk a little bit about non-qualified stock options. Non-qualified stock options are a lot easier than incentive stock options because they don't have any additional tax benefits. When you exercise your non-qualified stock options, everything gets immediately triggered as ordinary income. After that, it's as if you just bought the shares outright, and so you get to participate in long-term or short-term capital gains or losses, depending which direction the stock price goes. With that in mind, many people decide to sell their non-qualified stock options as soon as they vest because once again, there's no additional tax benefits and they want to capture that liquidity and then reinvest it in a direction they see fit. I highly advise you against exercising non-qualified stock options at a pre-IPO company because there's no market for selling those shares, so you can be saddled with a tax bill and have absolutely no way of paying it. Some people do consider exercising non-qualified stock options as an early exercise when the spread is negligible because there's not a lot of ordinary income, and then they get to participate in a lot of the upside potential and long-term capital gains. And then sometimes people would decide to exercise non-qualified stock options because they may be able to participate in the qualified small business stock exemption, which basically allows you to avoid all capital gains if the gross asset value of your startup is below $75 million now. That's something you better talk to your CPA and CFO about, but that is one exception where people will exercise non-qualified stock options early. And another tip, if you're going to recognize AMT by exercising ISOs, this can be a really good opportunity to also exercise some non-qualified stock options because the parallel tax system works in such a fashion where as long as that ordinary income is below the AMT, you're actually not going to recognize it, or vice versa. You might have recognized a lot of ordinary income and you exercise some ISOs because the AMT is never going to exceed the ordinary income. So there's ways you can actually pair up ISOs and non-qualified stock options together. Now, here's one really important key insight when it comes to non-qualified stock options. Non-qualified stock options give you one specific benefit, which is you get to participate in the upside without risking any of your own capital. And there's a ratio that us financial advisors use. It's called the inside ratio or information ratio. And it basically compares how in the money are those stock options versus how much more time you have left on those stock options before they expire. And so if you're holding non-qualified stock options and there's a lot of time still left and they haven't really appreciated a whole lot, usually that means it's a good idea to keep holding them. Alternatively, if they've appreciated a very significant amount, you're running out of time before they expire, which is usually about a 10-year window since the grant, we usually say exercise those because most of the value has already been recognized. And finally, let's talk about RSUs. RSUs are simple, but they can be absolutely brutal when it comes to your taxes. RSUs for most startups pre-IPO have what's called a double trigger provision, meaning that in order for them to actually vest and hit you on a tax bill, two things need to happen. You need to be at the company long enough to meet the vesting schedule, and at the same time, the company needs to have a liquidity event like an IPO. But what happens during an IPO? Let's say you've been at a company for 4 years right before the IPO. That means all your RSUs are going to vest all at the same time. RSUs are taxed as ordinary income, so it's going to massively spike your tax bill. And the worst case scenario is you have a 6-month lockup period before you can sell any RSUs and the company value drops. This has happened at Figma, this has happened at Uber, and I've personally navigated clients through this very tough situation where they're essentially now selling to pay the tax bill, but at a significantly depreciated value. When it comes to RSUs and investing at IPO, you also got to keep in mind the actual tax bill. Now, RSUs will have some withholding implemented by the company, but for the most part, it's usually not enough. So it's usually really valuable and important to calculate that tax delta, the difference, and make sure to set aside the cash in order to pay the tax bill the following year. And then finally, just like with non-qualified stock options, if you have a bunch of RSUs vesting, your ordinary income spikes, you can use that as an opportunity to exercise some ISOs and recognize that AMT preference item, but not so much where you're going to also be hit with AMT tax. So those are the different forms of equity compensation that you could experience before the IPO, during an IPO, how to navigate, make decisions around it. And there's no one fit solution for everybody. The right decision depends on your cash flow, on your financial goals, on your risk tolerance, on how bullish or bearish you are about the company, and on the tax ramifications. So all these things come together as you're trying to make the decision to maximize your wealth and achieve your financial goals. I always like to say equity should support your life, not dominate it. And this is where working with a qualified financial advisor or tax professional becomes exceptionally critical. If you're navigating an upcoming IPO, you have RSUs, ISOs, non-qualified stock options, reach out to somebody. We're happy to help you out with that and navigate you through this challenging time in your life that can also be an amazing opportunity.